the Fed now for quite some time, especially with obviously what's going on with the rates as of late and inflation. And so I think let's just go to the basics. I mean, one of the things that's amazing to me, Ron, is that just how I mean, you watch Jerome Powell speak, and it changes the markets, changes the trajectory of the economy at times, and yet very few
Yeah.
people truly understand what is the Federal Reserve, how was it created. So let's just go to the basics. Like, how would you explain what is the Federal Reserve? Is it a federal agency? Is it a private bank? What is it?
Um, okay, so the Federal Reserve is the nation's central bank. And what is that exactly? Well, this nation's central bank is essentially, the bank of the federal government. And we do a lot of things, and I could go into a fair amount of detail on that. But generally, so historically, it was created in 1913 by an act of Congress. So we are a creation of Congress, but we are essentially kind of a quasi-public, quasi-private organization. I can tell you a little bit more about how we fit in both buckets. But generally speaking, we are an independent agency within government is how the best way to think about it. When they set the Federal Reserve up in 1913, they really wanted kind of a distributed power model. So that's why there's a board of governors in Washington, D.C. That's Jerome Powell and the board of governors. And then there are 12 banks located across the country. And each of us are independent in our own right. We set our own budgets, things like that. And we each have a territory. Now, we're the 9th Federal Reserve District in Minneapolis, and our territory, each of the district banks have a territory where they're essentially expected to provide service and pay attention to that economy. Our economy in the 9th Federal Reserve District runs Upper Peninsula of Michigan, Northwest Wisconsin, Minnesota, North Dakota, South Dakota, and Montana. So it's a very big region, one of the more lightly populated regions of the 12 district banks. And in terms of what we do at the district level, there's a number of things, but I would kind of point to three basic duties that each of the district banks focus on. The first one is that we supervise and regulate banks. Now, not all of them, in fact, not even that many, but all of the really big, systematically important banks, the Wells Fargo, the JP Morgans, those big bank holding companies. We also offer financial services. So we oversee the nation's payment and settlement system. So, for example, if people out there listening happen to get a direct deposit for their check, there has to be somebody that essentially clears that payment, says, yes, the payer has enough money, goes into the person's account, that payment is cleared. We do that. And then we're the lender of last resort. When the finance sector gets in trouble and needs liquidity, we're the place where banks can go as a last resort for capital. And then we set monetary policy, and that's really the space that I work in. And here, there's really a number of things to talk about, but what I would bring to your listeners is that monetary policy is really, it's the thing that I think people are most familiar with in terms of setting interest rates. But what I would point you to more is our dual mandate. So when Congress created us, they didn't do this immediately. I believe they did this in the late 70s. They gave us kind of a dual mandate. And what that means is when we think about monetary policy, we want, Congress wants the Federal Reserve to think about it in two ways. They want the Fed to think about monetary policy to stabilize prices. Now, again, as you mentioned, we're not in that space right now, so we can talk more about that. But the reason we want stable prices is really for investment. Investment is what drives the economy, and if people see stable prices, both businesses and homeowners are more likely to invest in the future, and that really is what drives the economy. And then the second part is maximum employment. So when we think about monetary policy, we want to know what's happening to maximize the opportunities for people to work. And that is more of a moving target. Happy to talk more about that. We used to think maximum unemployment, we used to think maximum employment was 5% unemployment. We clearly know that that's not the case anymore. So we're still learning exactly how we can maximize employment, but it's really those two things that we're always trying to trade off or complement each other as it relates to when we raise or lower interest rates and do other kinds of monetary policy things. So I hope that made a real quick kind of primer.
I mean, really, that was very thorough. So I appreciate it. And you said so much that there was like, oh, I want to talk about that. I want to talk about that. So if you're just joining us, Ron Wirtz, he's the Regional Outreach Director for the Federal Reserve Bank of Minneapolis. Been there for a while, so he knows our area really, really well. He's going to stay with us for a couple segments. We're going to have him again next week, hopefully kind of an ongoing conversation with you so we can really get a good lay of the land of what's happening economically within our community. Now, I want to back up where you said, hey, Chris, we're quasi-public, quasi-private. Explain that in more detail, because my understanding, I get that the Congress, quote unquote, created you, but you're still a private bank, yes?
Yes. So I guess the one way to describe it is, so all of the Board of Governors, they are appointed and approved by the Senate, recommended by the President, approved by the Senate. So they are all publicly appointed. But each of the individual district banks, we all have private boards of directors. So they all come from the private sector. Some of them may be from nonprofit organizations, and there's 3 different classes of directors. So we have kind of good representation across our geography and across the economy. So we get different perspectives. So my president, Neil Kashkari, so he can get good advice, good counsel from his board of directors in terms of what they think about monetary policy and in terms of running the organization.
You don't know if I've ever asked this question, so hopefully you're comfortable asking it, but like, who pays you? Is it the taxpayer that pays you guys?
Well, no, we don't. We get no tax money directly from Congress. So there's no appropriation to the Federal Reserve System. So we have a balance sheet, and I think your listeners are probably familiar that, our balance sheet has increased because we've been trying to keep interest rates low. And by doing so, we've been in the market buying securities to try to keep the price of those low. Well, if we own securities, we get interest on that. We give the large majority, especially up until this year, we were giving close to $100 billion back to the Treasury, actually, because our balance sheet was very large and we were making a lot of money. Now we take a fraction of that to run our operations, roughly about $5 billion a year. So there are direct appropriation. If we gave all the money back, then there'd be no money for us to have a Federal Reserve, I guess is how I would put that.
Completely understand. Again, if you're just joining us, I'm really excited to have Ron Wirtz with us. He's with the Federal Reserve Bank of Minneapolis. One of the things that you mentioned that I just wanted to push back on a little bit and see if you can explain to us is you said, hey, Chris, it's really important that we have stable prices. I want to get into that more in detail in a moment, what jumped out to you from yesterday's report. But I think you said, hey, Chris, what we find is that stable prices actually cause people to make more investment. And I think if you look at over the last at least few years when you had these very, very low interest rates, I think a lot of business owners and homeowners and a lot of people would suggest that it was the low interest rates that was the impetus to the investment, not necessarily stable prices.
Could you give me that question again? I'm not sure I understood where you're going on that.
So you'd mentioned, hey, Chris, one of our mandates is to make sure that we have stable prices. So, that 2% of inflation, right? And so you'd suggested that what we find is that when we have stable prices, then more people are more apt to make investments. And I guess I would say that may be true. I don't have all the data in front of me, but all I know is when I saw the very, very low interest rates, you saw a lot more capital investment, a lot more investments in real estate than maybe just not necessarily based on stable prices, but based on very low interest rates. Seems like that was more of a precipice or a impetus to make investments rather than stable prices.
Well, what you want to remember, Chris, is we're trying to do 2 things at the same time. We're trying to keep a low price environment, a low inflation environment is a better way to say that. And we also want to try to encourage maximum employment. So that's why rates were low, because the Federal Reserve thinks so long as there's not inflation, we want to keep rates as low as we can to encourage people to take out those loans, to invest, to make capital expenditures. And they are going to do more of that if rates are actually low. So, when you came out of the Great Recession, I think there was a lot of nervousness, maybe even in the Federal Reserve, about very low rates and its inflationary impact. Well, it took 12 years and it never showed up. So that's why rates stayed low the entire time, because we kept seeing we didn't see, frankly, a really strong job market really until you got to be about maybe 2015. Now, they'd be different in North Dakota because of the Bakken boom and things like that. But nationwide, we knew that we need to try to create more jobs. Inflation was not to be found. So that's why rates were kept low. And that's why you did see kind of that capital expenditure, that capital expanse that you did. It was because rates are low, yes, but it's also because we kept them low to encourage more employment creation.
Ron, we've got about another probably minute and a half here, and like I said, we'll keep you through to the next segment because there's just so much to discuss. But I did want to get
Yeah.
you, and if you want to continue this in the next segment, great. But so yesterday, the numbers come out a little bit hotter than maybe people expected. What really jumped out to you? And I want to ask this from a standpoint for our listeners, like what was the most important piece of information in yesterday's inflation CPI report that you think matters to the people listening right now?
I think the overall number, just that we are still seeing a high price environment. And the Fed really, really is paying attention to this, and particularly for low income houses, those that are a little bit better off can absorb inflationary shocks a little bit easier. Nobody likes paying more at the pump, but for those that don't have options, to trade goods or maybe just absorb a little bit higher costs, low-income households are really struggling in this environment, and we understand that. So the fact that we didn't see much movement in the CPI numbers, we're paying a lot of attention to that, and we're hoping to see a little bit more traction on getting inflation under control.
So based on the number from yesterday, do you anticipate 75 basis points in November and December?
That's way out of my pay grade, Chris, so I can't.
Okay.
Okay.
That's fair.
What I will tell you is that the Fed has gone on record to say that we expect to make additional increases. How big those are, we're a very data-driven organization. So I would say that recent numbers are not going to pull us off that stance for sure. Now, I was with President Kashkari actually earlier this week, and he said publicly that he does expect, and his colleagues at the FOMC expect kind of the real natural rate to be somewhere in the 4.5% in terms of the federal funds rate. Now, with the numbers, with what's come out recently, I don't know whether or not those estimates are changing at all. I think what's safe to say is two things. We are likely to increase rates, and we are likely to do so fairly aggressively until inflation is really under control. They see this as the number one job, and I think they will be relatively aggressive, or maybe even very aggressive, depending on what the data are suggesting.
Fascinating conversation.